Hello everyone, this is a market update for the third quarter of 2025. The last period has been a very strong one for multi-asset investors. And in this presentation, we will look at asset performance and driver. We will then review the flying color portfolio performance and positioning. And we will conclude with our near-term outlook. But first, let me introduce myself. I am Renzo Desbordes, Investment Director at Flying Color. I am Chartered Financial Analyst and hold few other qualifications as well. I've been at Flying Color for the last 3 years, and I worked in major financial institutions over the last 20 years. So let's start with the 3 key themes that shaped markets this quarter. 1 was inflation, 2 was geopolitics, and 3rd was corporate strength. How those impacted asset performance? So theme 1, inflation. Inflation is slowing but is still high, and it has moderated from its peak, but it remained above central bank target in many regions. This environment has had a mixed impact. Gold was a standout performer, returning over 16% for the quarter, as investors sought protection against persistent inflation. Fixed income assets, especially UK gilts, struggled to deliver positive return as expectations for rate cut were pushed further out. The second theme, geopolitics, was positive for emerging markets in Japan but negative for Europe. Supportive policy measures in China have boosted investor confidence and stimulated growth across Asia. In fact, Asia-Pacific and emerging markets led equity performance. In Japan, the Topix index rallied on the US-Japan trade agreement, which brings more clarity for Japanese exporters, while ongoing structural market reforms support investor flow into the country. In contrast, European equity lagged behind, facing significant headwind from political uncertainty, particularly in France, where ongoing government instability weighed on sentiment, and in the UK, where persistent budget concern created additional volatility. Those factors dampened return across much of Europe. Our last theme, corporate sector resilience. And in the US, the stock market showed remarkable strength, with 77% of companies beating earning estimates. This is an impressive feat given how high are the expectations. Robust consumer demand, strong balance sheet, and innovation, especially in technology and consumer discretionary sector, drove results. High-yield corporate bonds also performed well, benefiting from investor appetite for risk and strong fundamental of many insurers. So where does that leave us in terms of flying color portfolio performance? It's fair to say that we reap the benefit of the strong market. We managed to beat our benchmark by 1.65% in the defensive portfolio and by over 2.5% in aggressive portfolio. This quarter, we benefited from the rebound in emerging markets in Asia Pacific and from the continuing strength in Japan. We also avoided underperforming bonds. Over the long term, our performance remains strong. The 5 years numbers are positive and ahead of benchmark for most portfolios. And more importantly, all of this is done while delivering superior risk-adjusted returns than the peers. In response to persistent, stubborn inflation, Prosperity Shield has been positioned to strengthen resilience and enhance return potential. We refine our sovereign bond exposure, focusing on regions with attractive real yield and strong valuation to support and protect real return. Interest rate sensitivity is actively managed to reduce volatility in this uncertain environment. We also introduced a modest allocation to commodity, providing an additional layer of inflation protection. Finally, to generate return in this challenging environment, we took advantage of the strong resilience in the corporate sector, allocating to high-quality bonds that benefited from robust fundamental and investor demand. We are benefiting of stronger corporate sector resilience, with allocation to companies demonstrating robust fundamental and earning growth. The improving geopolitical environment, particularly in emerging markets and Japan, has provided additional tailwind, supporting equity performance in this region. Throughout, we maintain a strong focus on the valuation, and as such, we have a lower exposure to the US, ensuring that portfolio exposure are concentrated in assets offering attractive long-term valuation support. In terms of outlook, we see three main risks that remain. Number one, market concentration, and that is more true in the US than in other regions. Number two, speculative behavior, particularly around AI. And number three, inflation. And yes, while global growth is slowing, it still remains positive. Also, inflation is moderating, allowing central banks to be more accommodative. And at the same time, global stimulus from China and Germany, alongside with easing trade tension, offer a constructive backdrop for risk assets. If you have any question or comment, please contact your financial advisor or reach out to us directly at Flame Color. As I have been discussing investment, I must remind you that your capital is at risk. Thank you very much.